Welcome back to Oil and Gas Futures 101. This is episode 5, Reading the Market. In the last episode, we covered money management, the 1 to 2% rule, position sizing, and stop-loss placement. Now it's time to talk about how you actually decide when to get in and when to get out. That's what technical analysis is. It's reading the chart to find patterns, trends, and signals that help you make better trading decisions. You don't need to be a math genius. You just need to understand a handful of tools. Let's get into it. The most common chart type in futures trading is the candlestick chart. If you've ever opened TradingView or Thinkorswim, you've seen these. Each candle represents one time period. That could be 1 minute, 1 hour, or 1 day depending on your chart settings. Every candle tells you 4 things. The open, where price started. The close, where price ended. The high, the highest price reached during that period. And the low, the lowest price reached. The thick part of the candle is called the body. It shows you the range between open and close. The thin lines above and below are called wicks, sometimes called shadows. They show you the high and low. Here's the key. If the candle is green, the price closed higher than it opened. That's a bullish candle, buyers were in control. If the candle is red, the price closed lower than it opened. That's a bearish candle, sellers were in control. Long wicks tell you something important too. A long upper wick means the price tried to go higher but got rejected. A long lower wick means the price tried to go lower but buyers stepped in. These are signals, and they show up everywhere on crude oil charts. Support and resistance are the two most important concepts in technical analysis. Support is a price level where the market tends to stop falling and bounce back up. Think of it as a floor. Every time oil drops to $68, buyers step in and push it back up. That's a support level. Resistance is the opposite. It's a price level where the market tends to stop rising and pull back. Think of it as a ceiling. Oil keeps hitting $74 and getting rejected. That's resistance. These levels work because thousands of traders are watching the same prices. When everyone sees $68 as support, they place buy orders there, and the buying pressure actually creates the support. It's a self-fulfilling prophecy. Here's where it gets interesting. When a support level breaks, meaning price falls through it, that old support often becomes new resistance. And when resistance breaks, it can become new support. This is called a role reversal, and it's one of the most reliable patterns in trading. How do you find these levels? Look for areas where price has bounced multiple times. The more times it bounces off a level, the stronger that level is. 2 or 3 touches is good. 5 or more is very strong. In episode 4, we talked about placing stop losses at technical levels. This is what we meant. You place your stop just below support if you're buying, or just above resistance if you're selling. Moving averages smooth out the noise and show you the overall trend. They're one of the simplest and most powerful tools on the chart. There are 2 types you need to know. The SMA, simple moving average, takes the average closing price over a set number of periods. It gives equal weight to every day. The EMA, exponential moving average, gives more weight to recent prices, so it reacts faster to new moves. The 3 most important moving averages are the 20-day, the 50-day, and the 200-day. The 20-day shows you the short-term trend. Day traders and swing traders watch this one closely. The 50-day is the medium-term trend. Institutional traders use this as a benchmark. And the 200-day is the long-term trend. This is the big one. Here's the rule of thumb. If price is above a moving average, the trend is bullish. If it's below, the trend is bearish. Now here's where it gets really useful. When the 50-day moving average crosses above the 200-day, that's called a golden cross. It's a major bullish signal that often marks the start of a long uptrend. When the 50-day crosses below the 200-day, that's a death cross, and it signals a potential long-term downtrend. One important thing, moving averages are lagging indicators. They tell you where price has been, not where it's going. Use them to confirm a trend, not to predict one. Now let's talk about momentum indicators. These tell you how strong a move is and whether it might be running out of steam. RSI, the Relative Strength Index, measures momentum on a scale from 0 to 100. It tells you whether a market is overbought or oversold. Above 70 is considered overbought. It doesn't mean sell immediately, it means the move is stretched and could reverse soon. Below 30 is oversold, the sell-off is stretched and a bounce could be coming. The sweet spot is looking for RSI divergence. If oil is making higher highs but RSI is making lower highs, that's bearish divergence. The uptrend is losing momentum even though price is still climbing. It often predicts a reversal. The opposite, price making lower lows while RSI makes higher lows, is bullish divergence. MACD, MACD, stands for Moving Average Convergence Divergence. It sounds complicated, but the concept is simple. It shows you when momentum is shifting. MACD has two lines, the MACD line and the signal line. When the MACD line crosses above the signal line, that's a bullish signal. When it crosses below, that's bearish. The MACD histogram, those bars above and below the zero line, shows you the difference between the two lines. Growing bars mean momentum is increasing. Shrinking bars mean it's fading. Here's the key. Don't use RSI or MACD alone. They work best when they confirm something you already see on the chart, like a bounce off support combined with an oversold RSI reading. That's a higher probability setup. Volume is the number of contracts traded in a given period. It's one of the most underrated tools in futures trading. Here's the core rule. Price moves on high volume are more significant than price moves on low volume. If crude oil breaks above $72 on huge volume, that breakout is more likely to stick. If it breaks out on thin volume, it could be a fake out. Watch for volume spikes. A sudden surge in volume often marks important turning points, the start of a new trend or the end of an old one. Volume also confirms trends. In a healthy uptrend, you want to see volume increasing on up days and decreasing on down days. If volume starts drying up on the rallies, the trend might be weakening. VWAP, the volume-weighted average price, is the average price of a contract weighted by volume throughout the day. It's the price that institutions use as a benchmark. Here's how to think about it. If current price is above VWAP, buyers are in control and most of today's volume was bought at lower prices, people are sitting on profits. If price is below VWAP, sellers are in control and most volume was bought at higher prices, people are underwater. Day traders use VWAP as a dynamic support and resistance level. Price often bounces off VWAP during the day, making it a great entry point. This is especially true in crude oil, where institutional traders move massive volume. One more thing, VWAP resets every day. It's a same-day indicator only. Don't carry VWAP analysis from one day to the next. Let's recap. Number 1. Learn to read candlesticks. Green means buyers won that period. Red means sellers won. Long wick signal rejection at a price level. Number 2. Support and resistance are your roadmap. These are the price levels where the market is most likely to react. Place your stop losses around them, as we covered in episode 4. Number 3. Use moving averages to identify the trend. The 200-day SMA is the most important line on the chart. Trade in the direction of the trend, not against it. Number 4. RSI and MACD help you time entries. Look for overbought and oversold conditions, and use divergence to spot weakening trends before they reverse. Number 5. Volume confirms everything. A breakout without volume is suspect. VWAP tells you where institutional money is positioned. Use it. None of these tools work perfectly by themselves. The real edge comes from combining them. A bounce off support, with an oversold RSI, on increasing volume, with MACD crossing bullish, that's a high probability trade. Next episode, we're putting it all together, building a complete trade plan from start to finish. See you there.